Let's get started. Everyone ready?
Everyone ready?
Good morning, guys. Welcome to our first episode of At Home with Nikki for 2021. We are kicking off the year with a super exciting event. We are doing our first ever annual mortgage fitness review. And this is just a great opportunity for you guys to take advantage of Ed's generosity, basically. Ed is going to be giving you some tips and some information on assessing whether or not your mortgage is healthy and fit. I know for all of us, we all start out our new year with resolutions. Fitness is one of them. As someone who is an addicted gym rat, I will have to tell you January is the worst month at the gym because you see everyone who has made the resolution of getting in shape in the gym, hogging the machines, not using things properly. Okay, let me not sound like a real obsessed, grumpy gym rat here. But basically, it's that time where people make their resolutions to get healthy. And some of the things that we resolve to do may include our finances, but not necessarily assessing the things that we already have. We may make, resolutions to start saving or to start investing. But how about the fact that we should start by taking a look at our current situation, assessing where we are right now to determine if these are the right tools, resources, environment, if this is the right place for us to be. And assessing your home is one thing, but assessing your mortgage is another. And that's why we thought this was a great opportunity for you to really just start to assess, is this the right mortgage for me? Am I in the right interest rate? Things like that. So I reached out to Ed, who is my preferred lender partner. Ed is a very experienced mortgage broker with American Home Finance. They have their own company. I've been working with them for years. They're amazing. Ed is one of the most trusted resources in my toolbox because I can go to Ed and get all of the information that I need to help my clients get into the best mortgage possible. Ed, you've been a lender for how long?
25 years. I'm dating myself, but 25 years.
Wow. And, a couple of things that I know about Ed that are not necessarily mortgage related, he's going to roll his eyes, but he is a chef, correct?
Yes, I am.
Makes his own wine.
I do.
Super exciting. How exciting is that? You have a mortgage lender that's going to make a bottle of wine for you. Not a bad trade-off, in my opinion. But anyway,
very few of us left in the industry.
There you go. There you go. So we do have a little bit of a delay, guys. So if you see me pause, be patient. We're working out our technical difficulties. As I said, it is our first live for the year. So in any event, when I reached out to Ed about this opportunity to share some ideas with you, he was super excited to be able to help people in this. And our goal right now is just to give you a brief overview of some things to consider when you're thinking about whether or not you're in the right mortgage and is your mortgage and your finances in the right shape and health for your specific needs. We thought we'd give you a brief overview today, but you will have the opportunity to schedule a one-on-one consultation with Ed. No cost to you, no obligation to do any refinance or anything with Ed. We are just here as a team to educate you, and if we can help you in the process, it's a win. So I'm going to get started with, talking through some of our questions that we wanted to go through today. And, to get started, first of all, Ed, why don't you share a little bit with us about how can we know that we're in the right mortgage? What are some of the things that would make a mortgage unfit?
Well, what makes a mortgage unfit is one that doesn't exactly fit exactly what the borrower is looking for. I mean, there's so many different variations. Can you hear me? Because there is definitely a time delay here. Can you hear me clearly? Yes. Can you hear me? Okay.
We can hear you. Yes.
Okay.
Yes.
So It really depends on what
Everybody good? Everyone else, give us thumbs up if you can hear okay? Perfect.
Okay. So it really depends on what the borrower is actually looking for, because there's so many variations. And the reason why brokers are very good in this space is because when you walk into a retail lender, they're, one size fits all. And we don't feel that way. We want to evaluate the client and see exactly what their needs are and what their future needs are, so we can tailor a product that works for what they're looking for. I know there's a bit of a time delay, so I'm just trying to make sure everybody can understand and hear me.
So what are the different types of loan programs that are out there?
Well,
yes.
There's obviously first-time home buyers, there are seasoned buyers that have bought properties before. So a lot of it depends on the actual buyer, but there's FHA, which is a little more liberating from a credit score standpoint, lower money down, the debt-to-income ratio is a little bit higher. So there's a lot of benefits if we go with an FHA loan. There's conventional loans, Fannie and Freddie. There's all kinds of different guidelines. So it's really not a one-shop stop here. It doesn't work that way. We really have to figure out exactly, what works for this client, and then we tailor a mortgage that kind of works. And us as being the professionals, that's what we do. We really have to figure out exactly, what works for this client, and then we tailor a mortgage that kind of works. And us as being the professionals,
Guys, do we have feedback? Can you hear us okay? Guys, do we have feedback? Can you hear us okay? Okay. Okay. I'm going to keep going, Ed. Sorry. We iron out our differences as we go. So another question that I had for you is, what would make someone determine if an FHA mortgage is right for them as opposed to a conventional? And can you explain to us what an FHA mortgage is?
Yeah, that's a very good question. So FHA mortgage is offered by the government, and it helps people get into financing a little easier than it would be in some conventional products. One, by the down payment of 3.5%. It's a little bit less money in cash that we use. There's mortgage insurance associated with that, but the mortgage insurance is capped at a certain amount. It's 0.85% of the loan amount. So what happens is the debt-to-income ratio is, they allow for higher debt-to-income ratios, meaning how much, is going out as opposed to what's coming in from a gross income standpoint. So the other good part about an FHA loan is they really don't have any hits to the rate when it comes to lower credit scores. There are minimum credit scores for 600 or 20, depending on where we work with. But for the most part, the rate doesn't get affected by the lower credit score. Whereas if you get into a conventional loan and you have a lower credit score, the rate's going to get hit pretty well. You're going to have a higher interest rate, plus your mortgage insurance factor is going to be higher. So what we do from the onset is, when I pre-qualify a customer, I'm pulling the credit, I want to take a look at the income, the whole 9 yards, and I'm really underwriting that. And when I see it, it'll tell me whether FHA would be a better possible angle for them, or possibly go into a conventional loan. When I see it, it'll tell me whether FHA would be a better possible angle for them, or possibly go into a conventional loan.
Okay, I'm going to try something really, I'm going to ask you, Ed, can you call me again? Let's see if I can hear you on my phone instead of on the iPad. I feel like it's giving feedback.
Yeah, I think it is.
By my having both on. Okay.
So
stay on Facebook Live, but
Okay.
let's just, I'm going to turn off my iPad here.
Okay. Okay. Sure.
And then if you can call me on my phone, then I will hopefully be able to hear you on my phone instead with less feedback.
So I'll call you now.
Or Greg can call from his phone. Okay. And let's try this again.
How was that?
That's much better. I think there's yes, much better. Okay. Sorry, guys, again for the technical difficulties, but hopefully you're getting all this great information that Ed's sharing, right? So we talked a little bit about what makes a mortgage unfit. We talked about the different types of home loans and, you know, the difference between FHA and conventional and how someone would know if one is more appropriate for them than the other. I guess my other question to you is, can you tell us a little bit about people who are already in a home and maybe they are thinking about refinancing, they've heard all about lower interest rates, everybody's doing it, is it right for me, should I do a refi? As you can see, Lucy is very interested in this live video. Anyway, but yes, so everybody's wondering, should I refi? Do I, you know, tell us a little bit about refinancing your mortgage. What are some of the things to consider?
Okay, so for some people, refinancing is something that is a great tool if they need to. Right now, in this current market, with tax season coming, there are times that people need some cash for that. Student loans, you know, different things like that. Consolidated debt. If you've got a lot of equity in your property, getting a mortgage is probably the cheapest way that you can go to consolidate debt. So, and plus it's a fixed amount, and you can buy it down over time. So, there are costs associated with a refinance. The good part about it is it can be part of the equity of the property. You don't have to come out with money out of pocket. But in a lot of cases, there are people that have a house, let's just take a simple example, that's worth $500,000 and they owe $200,000. So when we analyze their debt, the credit report, you know, they might have $50,000 as an example of credit cards. So if you take 3% of that, that's $1,500 a month, which is about the minimum payment. If we were to take that $50,000 and refinance their first mortgage, so instead of owing $200,000, they owe them $250,000. What they'll find out is instead of paying $1,500, they might be paying $400 or $500 more a month, and that difference gets banged down on the credit cards. So if they pay what they're paying now, and we implement a refinance in the process, they can take what they're paying, same payment, and start banging down the credit cards one at a time. And for a lot of people, this works because it helps them consolidate their debt. And, you know, let's face it, we all have debt. Kids sometimes have to go to school or whatever. There's different reasons for all kinds of things. Tax time comes, you don't realize you owe $30,000 to the IRS, whatever it might be. So these are tools that we use to help us. Now, you may not necessarily get the best interest rate at this particular time compared to 6 months ago, whatever the case may be. But when we do an evaluation, we're really going to look for, you know, what saves you money overall is the best plan that works for you.
Got it. So we're talking about refinancing to get a better rate and refinancing also to maybe pull money out of the equity in your home, which is a whole other consideration that I don't know that people have given thought to. And that's a great option, you know, and still keep your payment lower or minimally higher and save money on in other ways. That's fantastic. Tell us a little bit about the process of doing a refinance as opposed to a mortgage. If someone is, you know, applying for a mortgage, what's the process, and does that differ if they're applying to do a refi?
A loan is a loan, so you're going to have to qualify basically the same way as purchase. But on a refinance, what will happen in most cases is what we'll do is we'll take a look at, what the proposed value, what we think the value is. We have some tools that we can look up the value and get an idea of what we think the house might be worth. Of course, the appraiser has to come and verify that. But we'll do that. And then, the process basically is when it comes to any refinance or any purchase or anything like that, we're always looking at income, assets, and identity, those three things. So income is a big part of it. If you're a W-2 employee, you work for a corporation, two pay stub, one pay stub, two W-2s, for the most part, takes care of that. If you're self-employed, it's a little more complicated. And a lot of self-employed people don't really, in a lot of cases, understand what they're qualified for. And nor should they, because it's very complicated. So we'll do an evaluation of the last 2 years tax return, business and corporate. We'll take the K-1s and so on and so forth, and we'll try to come up with a value. As long as they qualify for what we're trying to do, we're okay. And how we're going to qualify is how much income do we have compared to how much debt is going out. So when they first come in, when a customer first comes in some cases, they have a ton of debt. So it wouldn't qualify, let's say, for a purchase. But if I show that all these cards and these student loans, whatever get paid off, we can now eliminate that from their debt load, and they then qualify for the mortgage, which puts them in a 100% better position. So we always have to evaluate identity, assets, income. Those are the three things.
So this is like really a huge way to get yourself financially fit for the new year, is to do a refinance then.
Oh, absolutely. Some people only think of refinance is to lower the interest rate. But we're in a bit of a rate climbing environment, and from all indications, it looks like that'll keep happening for a little while here. So even though somebody has a 2.75 interest rate, they don't want to change it because whatever. Sometimes they'll say, well, how about if I get an equity line? Well, you could equity line of credit on your property, but an equity line has no lock. It's not locked. So as the numbers start to go up, well, your rate will go up along with that. So in a lot of cases, that's not the most effective way to do this. If you are at 2.75 and you had a cash out refi, let's say, depending on your credit score, whatever, let's say you're even at 3.25 or 3.5 or whatever it may be, you still might be in way better shape than you were before, because you have to take into consideration the debt that would consolidate, and also that you will, and I'll always put them on a plan that they start to pay down the debt. So therefore, their whole outlook is completely different.
I think what you just said was so critical for people to understand. I've been a realtor for 19 years, and I did not understand that with an equity line, the rate is not locked. So that is powerful. So, I mean, seriously, it is so important to have this conversation, and have this conversation ahead of making any kind of application for any kind of mortgage, refinance, et cetera, to figure out what is the best option for you based on what you're trying to accomplish. I've had a number of people reach out to me and say, hey, do you know anyone that can do an equity line? But based on what you're describing, that may not be the best option for them at all.
That's right. And when you explain it to people and show it to them, they'll understand. But in most cases, they hear all the advertisements and, and equity lines are expensive nowadays. It's not the way it used to be. And they're not cheap. And like I said, they're not locked. So, if this economy, goes in a positive direction, then, you're who knows where. And in other words, if you lock that loan and you have your 3.5 or whatever the interest rate might be, then you're locked. The only changes that can go to that payment would be whether taxes go up or insurance goes up, something to that effect. But your principal and interest will not change.
So just to kind of sit on this point for a minute, I'm thinking about people who maybe don't know the difference between an equity line and a cash out refi. So just to go over it, an equity line is where you have equity in your home. There is more, the home is worth more than you owe on it. And so you're looking at this difference and saying, can I use it in some way? So I know that typically people tend to do an equity line because they want to know that they have this cushion. It's available to them if they need it. They don't actually need it right now, so they prefer to do it in an equity line because the interest rate doesn't actually kick in unless they use it. Am I correct?
You are correct. And in that case, an equity line is a good tool for them. It doesn't mean an equity line is not good. It's a good tool because it is a line of credit. So on an example of a house that's $500,000, you hold 200, they'll go up to 85% of the value. So let's say you get an equity line of $75,000. You have a line of credit sitting aside, $75,000 that you can use, and you're only going to pay on it when you use it. So if you use $25,000 because you bought a car on the equity line, then you're going to pay based on that $25,000 interest only type payment, which is inexpensive. The payment is, and the other thing is you have to think about this too. If you put anything on a cash out refi or equity line, meaning cars and other things, boats, whatever, you can write off the interest, which you can't if you didn't do that. So the only downside with an equity line is that, if you don't need to use the money right now, it's fine to have it as line of credit, it's okay. But if you're going to use that, I would suggest that you lock it on a first mortgage because it's going to be a lot cheaper in the long run.
Tell us a little bit, because you've mentioned a couple of things right now about interest rates. And I think that is like the 800-pound gorilla in the room for a lot of people. We have come out of this period of the pandemic where interest rates were super low. Everybody was rushing to buy a home or refinance their home at these historically low interest rates. What are interest rates like now, and where do you, as an expert in the field, see them going?
Well, that's a great question. And interest rates, I mean, for the most part, interest rates have been historically low. You're right, and they're still historically low. I mean, they're still low. It's not that, there's anything crazy. However, over the last few months, they've been rising, not that quickly, but steadily rising, And the Fed's announced there'll be 3 significant rate events over 2022, and also another 3 in 23. So chances are that we're in a rising rate environment.
Okay.
And those low 2.75 and 2.5 don't exist anymore. You're in the 3 range nowadays. And part of it depends on the credit score, the value, the type of property you're buying, and all that kind of stuff. But an average, good credit score borrower buying a house, you're in the low to mid 3s, I would say now. It's rising towards a touch higher than that, The thing about it is they change every single day.
Right.
Sometimes people get, last week, the guy told me 3 3/8. Well, that was last week. Today it's, whatever. And, what we'll do a lot of times, we'll float, when we first take the customer application and upload to a lender and so on. A lot of times we'll float the rate and we'll see how we can maybe catch a dip in the rate and lock them. But in this type of environment, what we try to do is we try to really watch it, and at some point we get this thing locked. Because if you're at 3.5 and someone does 3.75, it's a matter of $120 a month, let's say, and it's just a lot less aggravation over the long run. You just lock the thing, be done. We're not at 6 or 7 or anything like
Right.
that. We're still at tremendously good rates. So I wouldn't worry about it too much, but it's definitely it's a bone of contention with a lot of people because they get a lot of quotes, and in those quotes, you can spend money to buy the rate down, and a lot of times they won't tell you that. So somebody said, my interest rate is 3%. Oh, really? That just costs you 2% of the loan amount, which could be $6,000 to get 3%. So what we do is we show them what the actual rate is, the real rate for today. If you want to buy it down a little bit, you certainly can.
Got it.
But I'm not sure in most cases. We suggest that because the rates are so low right now. Why would you steal your equity to gain another $10 or $20 a month? So it really depends. I mean, it's all, the answer to your question is the rates have definitely been rising a little bit. Nothing crazy, but they're definitely rising.
So when we talk about a rate lock, at what point can a borrower lock in the rate? Is there a fee to lock in the rate? And how long can you lock it for?
It's a great question. Here's the way it works. I mean, if somebody takes an application, if I take an application for a client and the rate's good, we can lock it in. Okay? From whenever we're ready to lock, we can lock. Meaning that once I have the application, they sign, ready to go, they have a contract, and so on and so forth. Locks are 15 days, 22 days, 30 days, 45 days, 60, 90, and so on. the longer the days, the more expensive an interest rate it is, so to speak. So if somebody is 60 or 70 days out and they're talking about locking their rate, the rate might be, 35 to 40 basis points higher because you've got to lock it for 60 or maybe 90 days. Now that could be a good tool for people in a positive rate environment like we're in right now to just lock it and call it a day. Other people want to gamble a little bit and they can float it. If we have 90 days or 60 days, we're watching the rates at all times, and as soon as we catch, a downswing, we can lock them at that point. So it's really a personal decision, But in the old days, we used to float everybody to try to catch all that. Nowadays, I kind of tell them at some point, I think we just lock this thing and call it a day. Only because the rates are good as they are. If they're trying to gain an eighth, they might lose a quarter in the end. So, that's usually what happens.
Got it. So tell us a little bit about the process. How does it work? Listening to you now, I think it's time for me to refinance my home. I think I have about $100,000 worth of equity from 2 months ago because that's what's happening in the market. Not really, but it feels a little bit like that sometimes, right? But I think my house is now worth about $100,000 more than I owe. So I have $100,000 worth of equity in my home. I think I'd like to refinance it. What do I do? What are my next steps?
Well, the first thing you do is to find somebody that you're comfortable working with, somebody you can trust. At some point, everybody has to put their toe on the water and say, okay, this is who we're going with, this is who I trust. And that's a big factor. You walk into a retail bank, you don't know who you're dealing with, and they're one size fits all. Whereas, if you have somebody that you're comfortable with, talks to you and you're okay to move forward with, then the first thing we do is we evaluate your debt and look at your income, and we see, number one, if you qualify. Because even if you qualified the first time when you purchased the house, doesn't mean you're qualified now. Things change, and that's a big deal. So we look at that. We look at the credit score. When you first purchased your house, you might have had a 780 credit score, and then, believe it or not, some medical collection came up, and you have a 680 all of a sudden, and we have to fix that. So what I'll normally do, I spend a lot of time working with my clients, and if I see some lower credit scores, in some cases I can fix them myself. And we'll go ahead and work with the credit agencies and get them fixed, because it's a huge difference from a 680 credit score, let's say, to a 780 credit score. So if it takes us a little longer to do that, in most cases it's worth it. Even if the rates go up to touch during the process, we're going to do a lot better on the refinancing. So that's the first thing, is to evaluate. The second thing would be, do you want a 30-year fix? Do you want a 20-year fix? 15? Do you want a 29, 28, 26? We can do any of those. And when we start doing the evaluation, you find that, well, I've owned my house for 4 years, so I don't want to go back to a 30-year. Okay, then we'll do a 26. We'll do a 26-year mortgage. We'll keep you kind of where you were before. You'll save at least one payment when you close. Sometimes two. Sometimes you don't pay the payment for that month, and then the following month. So that kind of helps with closing costs, escrows, things like that. But if you decide, okay, I want to go to a 15-year mortgage, well, I'll show you an evaluation that will take like an amortization schedule, and you'll find that you might save $100,000 in interest. So if you say, oh my God, there's X amount of dollars in closing costs here, well, it really doesn't matter, because the closing cost is still out of the equity, it goes on the back end, and you strip that off in the first year with the interest savings. So there's a lot of tricks here that we can look at, and really depends on you. What's your future? Are you looking to rent this house out later down the road and buy another one? Or what are we doing? We're going to sell this house later, or the family's growing, or we're going to have children.
Right.
All those things play into it. When I talk to people, I want to know what their future is, not only for now, what are they doing in the next 5 years, 10? What's the plan? What are we doing here? And that's really what it comes down to. It's really an evaluation, I think. If that makes sense to you.
Of course. I guess my next question would be, what kind of documents do they need to have on hand? What do they need to get ready?
Well, somebody like yourself as a realtor, you have to give us the last 2 years' tax return.
Yes. I may not be the best example, but anyway.
So, but then, here's what happens. let's just say the 2019, 2020 returns. We look at the corporate returns, the personal return. But in addition to that, that's just going to give us the income for 2020. So we really don't know what the income for 2021 is if you're self-employed. So what we're going to ask for is a year-to-date P&L.
Okay.
And the last 3 corporate bank statements verifying the types of deposits that your P&L is showing. What does that mean? It means when we're looking at that P&L, we want to see that you're consistent in, let's say, 21 with what you made in 20 and, let's say, 19, right? Making sure that you're not going in the reverse, that you're going positive. Why do we want the 3? And I say we, it's an underwriting guideline. The underwriters are asked for this. The reason why they want those corporate returns is because if you're making, $1,000 deposits a month for the last 3 months, and you're showing that you made $100,000 in income this year, that might not judge. That's not what they're looking for. So it's a little bit complicated. And when you get to self-employed like yourself, you're writing off a few things. Some things you can put back in. So it really needs to be evaluated. So that would be self-employed. If it's a W-2 person, in some cases it's one W-2 pay stub that we do. Very simple. Good credit, it's clean. A lot of times we're getting appraisal waivers. If the loan, right? If you have good credit and your equity position is high, and by equity we mean what you owe is compared to what it's worth.
Right.
It's worth 500, right? You owe 200, you have $300,000 in equity, you're at 40% of what the case may be. If I did that loan as a refi, in some cases I can get an appraisal waiver, which will save $500, and also people aren't going to deal with it. So those are some of the things that you need, and then you have the rest of it. Just so you know, the refinances, you give us the insurance, you have to change the mortgage clause, for obviously for the new lender. If you have a title policy when you purchase the property, if you can get us the owner's policy, we can get you a discount on that. The survey that you used prior, give us that. We don't have to order it. We use that survey, so we try to save money across the board any way we possibly can.
So I know we talked a little bit about my being self-employed and that changes the dynamic of the actual loan. Can you get a loan if you're self-employed? And what about things like, how do student loans affect your ability to qualify? And also a big one, how, I know a lot of people in 2020 deferred their mortgage. Do these things impact your ability to qualify for a loan?
Absolutely impacts it. And if you're self-employed, again, the guidelines we just talked about, those are the things that we're going to start to look at. Okay? When it comes to student loans, June of 2021, they updated the guidelines for student loans, which helped a lot. Because with FHA, it used to be they would count 1% of the student loans as your payment. Well, if you have, and I deal with this all the time, a young attorney or a doctor or a professional, $170,000 in student loans, that's $1,700 a month. They're not going to qualify for their house because they just don't make enough. So a lot of people are on those income payment plans with the student loans. So what the new change is, if you're on an income payment plan with student loans, FHA will either take that or they'll charge you 0.5% now instead of 1%, which is huge. Because if you had, in the last, let's say you had $150,000 in student loans, your debt income ratio is going to be hit by $1,500. What does that mean? Well, that means that you have $1,500 for student loans, and you have a car payment for $500, right? Then you have the house, which is going to be another $2,000. You have to make quite a bit to catch up and be able to qualify. When it comes to conventional loans, there's Fannie Mae, there's Freddie Mac. So it gets a little complicated, but Freddie Mac, like I have one right now with somebody that's an attorney, and she's got a payment plan with a zero balance. So as long as the credit report shows a zero balance, and she's showing a zero balance for more than 12 months, then I can use a zero balance of a Freddie Mac loan for her, which is awesome because she would not qualify any other way. She won't qualify conventional on Fannie Mae, and she certainly wouldn't qualify FHA, at least for enough of a house that she'd like to purchase. You know, nowadays, I mean, unfortunately for these younger people, prices are up. They have to qualify for quite a bit to try to buy the first time home. It's very difficult. So especially with the student loan. So that's kind of the way that works. It's definitely better than it was.
What about the deferment?
Deferment, when people did a deferment, you know, there was a lot of different guidelines with COVID. And unfortunately, the lenders never told these people that, you know, they would be hit with this. And a lot of times, you know, you'll see where they take the deferment, they put it on the back end of the loan. Other times they're going to show that they were late, even though they didn't pay it. I mean, we're trying to clean up the credit of what's left and right on this thing. The bottom line is that in some cases, oops. Can you hear me?
I can hear you. You froze up a little bit. I can hear you on the phone. I'm not sure if we...
I think we can find you. Okay, you said.
Yes, all good. Thanks.
In some cases, the deferment would have to be back in place. You have to start paying. In some cases, it's for 3 months, or the case would be. You don't have to, the bottom line is you have to catch up to where you were, and you then qualify for a loan. So it's very difficult when it comes to this. A lot of people didn't understand what really is going on there, but that was always, it's a tough situation.
Let me see. What if I don't qualify for a traditional mortgage? Is there an option for me? And what would make me not qualify?
Yes, and that happens quite often. And that is also a reason why a mortgage broker would be your best opportunity, because retail banks, lenders, they have specific programs, and they're very, very, specific on what they'll do. Whereas, we are able to shop. I have 30 or 40 different lenders, and there's non-traditional loans, which is not what we're talking about. This is now a whole different set of loans. It's like a boutique lender, rates and interest rates, fees, but it's a loan that they couldn't qualify for. But in some cases, they're good, solid borrowers, and they'd like to buy a loan. I'll give you an example. If you have somebody that is self-employed, you have to be self-employed for 2 years to qualify for a Fannie or Freddie loan or FHA. So if you're not, 2 years in business, you're not going to be able to qualify. So one case is there are people, as an example, that want to buy an investment company.
Right.
So we have a loan called the DSCR loan that, as long as the rent is higher than the principal and interest payment, PITI, principal tax insurance, as long as the rent is higher than that, they're qualified.
Okay.
We need a 620 credit score, 680 depending. Different lenders have different guidelines on it, but there's no income verification. I have to verify income. We don't care if it's your income. So it's called a business purpose loan. So it can't be with somebody moving into the property and you're making believe, and that doesn't work. That's not what it is. This is they're going to sign documents and say this is an investment property, but we don't care about income. They have a decent credit, qualified. So that's one. Another one is, Nikki, doesn't show enough income, but boy, she makes a lot of deposits in her real estate business. So I can take the last 12 months of either her personal or her business accounts and use that as income to qualify for loan. Now, you're not going to get 100% loan, 95%. In a lot of cases, it's 75 or 80%. You have to have some cash to put down. But the nice thing is that if I took your business, we're going to put an expense factor of maybe 50 or 60%, because you know that there are expenses. But that 40%, that would be your income, and that's how you qualify for a loan. So interest rates would be a little bit more than it would be if you qualified, conventionally, but that'll get people into houses all day long. Works every day. So another quick one is asset depletion. So you get somebody that moved down from North, they sold their house, they have $3 billion in the bank, and they're on Social Security, and they want to buy a house for $400,000. Well, they don't qualify because you only qualify based on the income, right? So if your Social Security is not enough to qualify for this payment for a $400,000 house, there's a formula we use. We take that $3 million, we put it through a formula, and we'll give you credit for income based on the amount of money you have. That's called an asset depletion loan, and that works all the time. It works really well for people because they do have the money. It's just that they're not qualifying to get in the house. So we're not putting them in any sort of risky, which by the way, that's one thing we never do. We're not going to put anybody in a risky situation that could fall later. We know that if they have $3 million, they want their house. They can buy cash if they want to, but they don't have to. They can do it that way. So there's a lot of different alternatives out there.
Ed, it sounds to me as though there are many options for people who want to purchase a home and have been told maybe that they don't qualify or they don't know where to start or want to do a refinance or are considering it. Sounds as though you have a lot of options for people. And so it seems like this would be a really good time for you to tell people what would be their next step. Like if they wanted to do a consultation with you to determine if their mortgage is healthy or if their situation is healthy enough for them to qualify for a mortgage, how do they get in touch with you?
Well, they can get in touch with us. The phone number, from our office, or a lot of times my cell phone, and I'll give you all that information in a minute. They can email me. They can make an appointment with the office. What we do is we'll set up these consultations with the clients. And, with COVID, we used to see them in person. Nowadays, it's over the phone or through a Zoom meeting. We can do any of those. That doesn't really matter. We do loans all in the state of Florida. We're licensed in the whole state. So if they want to make a phone call, make an appointment, a lot of the other thing I would tell you, Nikki, is there are some people that just don't qualify for a house right now. Okay? That's just what happens. They might have a tough credit score. They might have some issues in the past, whatever. But and I've been doing this, like I said, 25 years. So I have a lot of people that I'm working with that I put kind of on hold for a little bit. But what I'll do is I'll help them, kind of show them what they need to do. So next year they're ready to go. I mean, if you have to rent this year, it's not the worst thing. You rent the house, everybody relaxes. But at this point, I need you to save some money. I need you to pay this off. We need to do this. We need to fix it. So by next year, when they're ready to go, they have a nice, clean mortgage. Because there are times I can get them a mortgage and I don't want to. Because it's not exactly the kind of mortgage that we should get for them. If I can help them fix their credit, possibly in assets and income and all those different things, next year, their outlook is a completely different field. So those are some of the things we do. If anybody wants to get in touch with us, we can, you can obviously call the office or email us or whatever. I'm always happy to talk to people. That's what I do.
Another option that we have is the American Home Finance Group is the name of the company, and they do have a Facebook business page. And if you go to the business page, there is an option to book now. So you can actually schedule a consultation through the Facebook page, or you can go to our website, the riettiegroup.com website, click on the tab that says Get Pre-Approved for a Mortgage. It's in the menu at the top. That would be another great way to get in touch with them. Or go to their website, American Home, your website.
Unfit.com is a good place to start because people can fill out their own application. They can pull their own credit if
Right.
they want to. There's a lot of nice things, nice features on there. And once that happens, we get emailed or text to say that somebody actually went on and started and completed the application. And then what I'll do is then I see it in the back end and I turn it around. I can pull credit, or if the credit's not pulled, I can pull it myself. We have, you have to agree to pull your credit because that's another thing that people have to understand. I can't just pull credit anytime I want. It doesn't work that way. And it costs money to pull credit, so I'm not dying to pull credit from people. But people have to give us some sort of either verbal or, written authorization to be able to pull their credit, which is really important. So be careful when people are just pulling your credit willy-nilly because it doesn't work that way. Every time you get your credit pulled, you have to verify you pulled it for what, and, all that. So there's a lot of things that are being looked at. We start to lose some credit points every so often, but they pull it how many times. So you want to be very careful, and you want to authorize if somebody's going to pull your credit or not. There are times that I don't pull their credit because they don't want me to. And I'll say, all right, give me what you think it is, and I'll give you an evaluation based on what you said to me. And then at some point, when we're ready, we'll verify exactly what it really is, and then we'll kind of go from there.
See,
And,
you're touching on something that I actually, as a realtor, I really want to actually break down a little bit. So I just want to share a little bit about how that process works. You're interested in buying a home. You want to know if you qualify, but you've heard that people pulling your credit, it's a hit on your credit, it will reduce your score. So you're nervous about having anyone pull your credit. You can, I'm sorry, I'll just point out that the Get Pre-Approved link is now in the chat in this thread. So feel free to go there to get some more information on getting pre-approved. But so going back to what we were just saying, you don't want to get your credit pulled. That is called, so you speak to the lender and you tell your lender what you think your score is. That's called a pre-qualification, correct?
Yeah, I mean, people call it pre-qualification, but I'm going to tell you something else, and you have to realize that what we can do, and not everybody else can, is we do what they call a soft pull.
Okay.
So if we do a soft pull, I'll see the scores and I'll see what the debt is, but it's not really a pull on their credit. Now, I can't use that for a lender. I'll have to pull their credit when we're ready to loan. But, for people that are a little worried about those items, a soft pull is the way to do it. So we can certainly do that. Now, when you come to pre-qualification, pre-approval, sometimes people walk, especially realtors, because you really don't want to start the process until you know these people can truly get a loan. And when I work with any realtor, especially, I spend a lot of time basically underwriting the file before they even start, so we know exactly what's going to happen. The customer might say, "Oh, I want a $500,000 house." Great, you run around looking for 500. Everybody's excited. The listing agent. Meanwhile, they don't qualify for any more than 350. So everybody wasted their time. I mean, we always say that really the mortgage is the first place to start. When it comes to pre-approvals, when they get a letter from me, I'm really doing listing agents. I already know where to pull it. And some of the banks, you'll say, "Oh, I make $100,000 a year, I have 750 credit score, and this." Okay, here's your letter. Well, that doesn't help the listing agent, but just like the listing agent going on everything.
Right.
There's nothing to know that. But I'm going to just say that when we do it, I don't send the letter out, and maybe you know this by now. I'll wait. If I have to wait an extra day or two, again, people have to put their toe in the water. If they really want to get a mortgage, I have to see it all. I mean, because one little thing that comes through that we didn't look at made a difference from them closing the loan, or everybody wasting their time. Kind of realtors, everybody. So, not to say that we're perfect, and things do come up in the process that we might not see, but we certainly try to see everything. I pull in the license statements on everybody and see exactly what's going on. So before the underwriter sees that file, they've already underwritten for them, and I hand them the file that they're ready.
So these are super important factors in an environment like we're in right now, where it's such a competitive housing market. Your homeowners are getting multiple offers on their home. You have to have all your ducks in a row as a home buyer in order to have your offer accepted. Ed, can you tell us a little bit about something that as industry professionals, we are hearing more and more and more people ask for a DU, and buyers come to me all the time. They want a DU. What's a DU? I have realtors ask me, what's a DU?
And realtors, they know more and more about this as time goes on.
Yes.
So the DU is excellent. There's nothing wrong with the DU. DU is, they call it a desktop underwriter. And what that is, that's a Fannie Mae approval. So what does that mean? So I've now taken somebody's application. I have a full application. I have their tax returns. I have the whole 9 yards, W-2s, whatever it is that I need. So if Nikki says, "Oh, this realtor needs a DU," what I'm going to do is I'm going to run it through the Fannie Mae website, and I'm going to get a full approval. And once I get that approval, okay, I can now share that with the realtor or the listing agent to say to them, "Look, not only have I, evaluated them, I have all the documents. I ran it through. Fannie Mae is comfortable with this loan. They will buy this loan as is. Now, understand this. Garbage in, garbage out. Right? So there are people that can play around with these DUs that know what they're doing, and they can give you a DU that's not true. So it doesn't always 100% mean a DU is right. If you put in what's supposed to be, see, everything that's put in is going to be verified. Like, if I say that this guy's making $8,000 a month, he better be making $8,000 a month with that DU. So a lot of it has to do with that. But This is one other thing I'm going to tell you. With some customers, we're not quite sure if we think we're going to get it done. You know, there's a couple of issues. We can do a TBD approval. What does that mean? To be determined. We don't have a property yet, but I have a full credit file on this guy. I have everything I can do. We're going to run it the same way of the DU, but you'll see instead of a property address, you'll see a TBD. Now, in a lot of cases, my underwriters will completely underwrite that file. Now, I think he hasn't even shown the house yet. They haven't found it. But they'll underwrite that file top to bottom, and the only thing we need is a property, appraisal, and a contract. So, in some cases, we do the TBDs because we say, okay, well, reality, not only do you have a DU, but I have a full way to get the property somewhere in these parameters, and we're going to close this. So that's very powerful in this market. Very powerful.
Like I said, I honestly cannot think of anyone that I find more of a partner to me in the process of helping my clients than Ed Cairo of American Home Finance. The ability that and the time that he takes to sit and consult with the client, figure out exactly what their specific needs are and what's best for them. There are times that I'm ready to get that client out in my car and he calls me up and says, yeah, they technically they can buy now. This is not the right program for them. If you give me X amount of weeks or X amount of months, we're working on fixing what is holding them back from getting an optimum program. That's better for them. There are other instances where we're in a multiple offer situation and I need Ed to jump on the phone with the listing agent and help me win that home for my buyer. 100%. No matter what time of day, weekday, weekend, we get the deal done. So if you need to talk with someone about your mortgage and figure out if it's the best program for you, if you should do a refi, if you should cash out, or if you need to figure out how much home you qualify for, reach out to Ed Cairo of American Home Finance. I promise you will thank me later. You can buy me a cup of coffee because coffee comes from heaven. You know it. All right, guys. So that's all we have for you today. Before I go, I should ask, are there any questions? I forgot that. I've been listening. There's been so much great information. Any questions before we go? Give you guys.
I can say that I've worked with a lot of different realtors, but working with the Riettie group is just an absolute pleasure because they understand the business and it's so simple to communicate. And also the customers, every single customer that I've dealt with absolutely loves working with these guys.
Thank you.
So I just want to let you know that these guys really know what they're doing, which for us is tremendous. It's a great partnership. Love it.
Thank you. We love our peeps on all sides. We love our customers, we love our team, and American Home Finance is definitely part of our team. So it's a win all around. So guys, if you know of anyone who could benefit from this information and they weren't on the live today, it will sit on my Facebook Live in my videos. So please, tag them in the comments. They'll be able to circle back and see it later. Again, you can reach out to Ed through going to their business page, American Home Finance, click book now, and you'll be able to schedule a consultation, and their contact information can all be found there, or you can click on the link in the comments below for the get pre-approved page of our website. But I guarantee you it's the right time. Get in shape with your finances, talk to Ed, figure out if your mortgage is the right program for you, figure out if you qualify for a bigger home, a smaller home, whatever your dreams are. Start with Ed. It all starts with Ed, guys. It all starts with Ed. So thanks so much for joining us. We do have our for the month of January, we're doing a series on At Home with Nikki covering the topic of home ownership and buying a home. So tomorrow begins our regular series. We are rebooting that. It's At Home with Nikki, and we're starting with our first episode tomorrow in that series for the month of January. So be back. That's Facebook Live at 5, At Home with Nikki, and you'll find me right here sharing some great tools, tips, and tricks of the trade to help you get into a home this year. So Thanks so much for spending your Thursday morning with us. Thank you, Ed, for sharing your brilliance with us. We all have benefited so much. We've learned a lot. Thanks to my team, Janine, for being the wind beneath our wings behind the scenes. Thank you, everyone, and have yourselves an awesome day. Peace out.
And thank you, everyone. Thank you for listening. And I'm just going to let you know also that we're the Mortgage Brothers. So we have
Yes.
Greg, my younger brother, and Paul, my older brother, and myself. So when you deal with us, you never know who you're going to get. Three Italians.
There you go. And they're all awesome. So,
That's it.
yeah.
Have a nice day, everybody.
Thanks, guys. Peace out.
Peace. Bye.
Bye.